All right, welcome. Today, we are going to demystify a really crucial number that acts like a financial x-ray for a company. It's called the gearing ratio. So let me ask you a kind of weird question. How is a massive billion-dollar company anything like someone buying their very first home? I know it sounds a little strange, right? But the answer is actually pretty simple, and it all boils down to how they pay for their biggest, most important assets. And if you can get this, you're going to unlock a key secret to understanding a company's financial health. Let's break this down with an analogy you'll get immediately. So you're buying a house. That down payment you scrape together, that's your equity. It's the piece you own outright. The giant loan from the bank, well, that's your debt, your mortgage. It works the exact same way for a company. The cash they get from shareholders is their equity, and any loans they take out are their debt. The gearing ratio, then, is just a super simple way to see how those two are balanced.
Okay, so we've got the basic idea down. Now, let's roll up our sleeves and get into the nitty-gritty of how we actually measure this delicate balance between what a company owns and what it owes.
So at its heart, the gearing ratio, and you'll often hear it called the debt-to-equity ratio, it's the same thing, is all about one simple question. How much of this business is funded by borrowed money versus money from its actual owners? It's a direct peek into how much they're leveraging other people's money to run their operations.
And this slide, man, this really gets to the core of it. With debt, you've got a non-negotiable mandatory payment schedule. Doesn't matter if you had a great year or a terrible one, the bank always gets its money. Equity, totally different ballgame. That's ownership capital. There's no fixed payment, and that single difference is absolutely crucial when we start talking about financial risk.
You know, the best part is that calculating this thing is actually dead simple. It's just 3 steps. First, you find all the money the company owes. That's its total liabilities. Then you find the company's net worth, which is its shareholders' equity. And guess what? Both of those numbers are sitting right there, plain as day, on the company's balance sheet. Then you just divide one by the other. That's it.
And there it is, the whole formula in a nutshell. We're simply comparing what a company owes to what it owns. It's just a simple fraction, but believe me, it tells an incredibly powerful story about a company's financial situation. So, you've done the math, you've got the number, now what? What does this number actually tell you? What makes a number high or low? And what does that really mean for a company's risk profile? Generally speaking, analysts use these benchmarks as a rule of thumb. A ratio below 0.5, or 50%, is usually seen as pretty low risk. It basically means the company has at least $2 of its own money for every $1 of debt. But if that ratio creeps above 1.0, or 100%, that means the company is financed with more debt than its own equity, and that, my friends, starts flashing some warning lights.
And this is where we see the real-world consequences kick in. A highly geared company is essentially walking a financial tightrope. You know, a sudden economic downturn or a hike in interest rates can make those debt payments a crushing burden. But a company with low gearing? Well, they're standing on a much more solid foundation. They're more resilient and, frankly, a much safer bet for investors.
But hold on, it's not quite as simple as debt is bad. There's a really important trade-off here. While having low debt means you're safe, it can also mean you're missing out on huge opportunities. See, debt is often the cheapest way to pay for growth. A ratio that's too low might signal that a company's management is being way too cautious and not taking the smart, calculated risks needed to grow the business and make more money for its shareholders. Okay, now we're getting to what might be the most critical point of this whole explainer. A good or bad gearing ratio is not a one-size-fits-all number, not at all. It depends entirely on the neighborhood the company lives in. In other words, its industry. You simply cannot, you literally cannot, compare a big manufacturing plant to a nimble software company using the same financial yardstick. It just doesn't work. Their business models, their need for physical stuff, it's all fundamentally different.
Just think about it for a second. A huge manufacturing company needs to build massive, expensive factories. That takes a ton of borrowed cash. So for them, a gearing ratio of over 2.0 might be completely normal, just the cost of doing business. Or think about a fast-growing tech startup. They might take on a mountain of debt to fuel their rapid expansion long before they're even making a profit.
And that's the key takeaway here. The gearing ratio is most powerful when you use it as a tool for comparison. A 60% ratio looked at in a vacuum doesn't tell you much. But if you find out the average for that entire industry is 80%, well, all of a sudden that 60% starts to look pretty darn good, doesn't it?
All right, so we've established this is a powerful tool, but like any single tool in the toolbox, the gearing ratio has its limits. It's really important, but it can't tell you the whole story all by itself.
And this quote right here nails one of its biggest blind spots. The gearing ratio is like taking a photograph. It's a static snapshot from one document, the balance sheet, at one specific moment in time. It tells you how much debt a company has, but it tells you absolutely nothing about whether they're generating enough cash to actually pay it back.
And that is exactly why you will never see a professional financial analyst stop here. They always use the gearing ratio alongside other metrics, things like the debt to EBITDA ratio or the interest coverage ratio. These other tools are designed specifically to measure a company's cash flow and its real ability to handle its debt payments.
So why does all this matter? I mean, who really cares about these ratios? Well, it matters because when an economic storm hits, a company's gearing ratio isn't just some abstract number on a page. It has severe, tangible, real-world consequences.
Research from the Great Recession back in 2008 gives us a perfect and pretty brutal case study on just how important a strong balance sheet really is.
So, if you remember the boom years leading up to the crisis, a lot of companies were loading up on cheap debt to grow as fast as possible. They were becoming very highly geared, and this set the stage for a dramatic, painful split in what happened to them when the economy finally turned south.
And this is where the rubber really met the road. When the crisis hit, those highly leveraged companies were trapped. They were forced to lay off employees and slash their investments in the future. But the firms with low leverage, the ones with strong balance sheets, they could actually weather the storm, hold on to their people, and in some cases, even borrow more to get through the tough times.
So what this all comes down to is this. Debt is more than just a number. It has a real, direct impact on a company's ability to be flexible, to adapt, and to survive when things inevitably get tough. It's about resilience. The gearing ratio doesn't give you a simple, easy answer. But what it does, and what's so valuable, is that it forces you to ask the right question. And it reminds us all that sometimes, in this unpredictable world of business, the ability to simply endure is every bit as important as the ability to expand.